Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name's Tom Roseen. Thanks for joining me today. I'll be reporting flows, and this is estimated net flows into both conventional and ETF funds for the week ended November 11th, 2020. Now, the reason I stress this is in the past recordings that I've done, basically I've always kind of given a top line number and just looked at the mutual fund industry. But since we give a breakout and play-by-play by each of the groups by their conventional fund business and then also by the ETF fund business, basically I wanted to make sure that I was, making sure that everybody knew that I kind of changed my lineup here a little bit. For the week, we actually saw a fantastic set of inflows. We basically saw that the conventional fund business and ETFs took in about $27.7 billion, one of the largest we've seen in quite time. And certainly it is the first inflow in the last 14 weeks that we've seen. We've been in net outflows up to this point. And obviously, this is on news that everybody's been talking about, and that is the release of Pfizer and the group BioNTech, basically saying that they came out with a coronavirus vaccine that was 90% effective in their third portion of their trials. And basically I think people saw that as a big boon that this came through. Obviously there's the idea that's kind of keeping people back and forth, though the impasse by Congress to come up with a coronavirus relief package, a second round of packages. A lot of people think now that the election is over that might get passed in lame duck session, if not certainly in the beginning of the year. But again, because of the new rise in COVID-19 cases, and we're setting records in at least 17 different states as far as the number of both hospitalizations and cases being reported and diagnosed, I think people are looking for a little bit more of relief a little quicker, and I think that's what's been keeping people kind of off and on in this area. But again, fantastic returns as far as we went. We saw that there was a rotation out of what we'd call the stay-at-home stocks and the tech stocks that were benefiting from the lockdowns, and I think we'll see a little rise in those again over the next couple of weeks, because certainly the virus is going to be contained with the vaccines that are out there for at least the next several months, probably, as they come up with a distribution channel, get it approved. Even if the FDA gives them a rapid approval process, it's still going to take months before that happens. So there's a concern. But we did see a rotation into value-oriented stocks and out-of-favor stocks, cyclicals and the like. And basically we saw the Russell 2000 add about 7.54% for the week. Again, this is a Wednesday time period, which was kind of boon. And then we saw the NASDAQ actually be kind of the laggard of the group, still up about 1.3% for the week as well. But certainly not the runaway returns that we've been seeing from that group. Well, let's go ahead and see how this new news on the coronavirus vaccine actually helped, and certainly the end of the election and the like. A lot of uncertainties out of the markets now, and I think everybody's kind of relaxing a little bit more. Let's see how that transpired, though, as far as flows went. Let's take a look first at kind of our overall groups. When we take a look at the flows picture, we basically are looking at the macro groups, and we see that the equity funds took in $23.8 billion this week. That's a large amount of money, and again, it's like the third largest on record that we've seen in quite some time. If we take away money market funds, which again means that we'd be just looking at long-term assets in that case, but a big number there. Taxable bond funds took in $7.1 billion, also a big number. Muni bond funds took in $1.2 billion, and so again, the long-term assets were the main attractors of assets, and then we see money market funds handed back about $4.4 billion for the week as well. So this was actually, somewhat good news, because we have not been seeing flows into equity funds, and a lot of people think that this might be overdone. And in fact, in the last day, on Wednesday, we saw kind of a reversal. We saw stay-at-home stocks do a little bit better. We saw the Dow actually, stop its two-day winning streak as people kind of took a dose of reality and said, listen, this is great, but it is still in the third phase of the trial, and we need to really, seeing is believing in this case. So I think that's what most people are looking at. Let's go ahead and take a play-by-play look at the individual groups and see what happened. Equity funds, as I told you, did really well. We saw on average that they were up 3.92%. And if we take a look at the percentage change in market, that really is a 1 week return. And then basically it's the second consecutive week they've seen plus side returns. The prior week was actually very good as well. However, true to what's been happening over the last several months, probably almost the whole year, we saw saw outflows from the group. So equity funds lost about $2.2 billion. This is the 29th consecutive week they've seen outflows. How this broke out is we saw domestic equity funds hand back about $1.6 billion. That was the 22nd consecutive week they've seen outflows. They had a plus side return of 3.59%. Second consecutive week, they've also seen plus side returns. And then non-domestic equity funds saw about $562 million in outflows. Not a lot. 12th consecutive week, though, that they've seen outflows, and they had a return of 4.66%. So quite handsome again for them. Second consecutive week that they've seen plus side returns. If we dive down a little bit deeper and look on the domestic equity side, we see large cap funds handed back about $2.4 billion, while equity income funds, again, people have been kind of looking for that income component because the interest rates have been so low. Long end of the curve, by the way, on the fixed income side, we saw a rise. We're up in the mid-90s. We haven't seen that for a while on the 10-year Treasury, so we're going to see a little different behavior, I think, as we go forward. But on the equity side, we saw equity income funds taking about $316 million. Now, taking a look at the non-developed or non-domestic equity funds, global equity funds handed back about $662 million, while international equity funds took in about $100 million. So really that brings us now to the ETF side of the industry, and this is where we saw the big moves. I told you that we saw kind of record numbers come in. Well, that's exactly what we saw this week. Let's go ahead and jump to the slide for equity ETFs, and we see for the second consecutive week, they took in a large amount of money. This week it was $26 billion, the third strongest net inflow for equity ETFs going all the way back. Well, I'm going to say 1992. Obviously, very few ETFs go back that far, but it was the third largest on record that we've seen, and so it's been actually a pretty amazing feat. Now, if we take a look at play-by-play of who were the winners, who were the losers, we see the S&P 500 ETF, that SPY, basically taking $13.7 billion, and we saw the iShares 2000, Russell 2000, taking about $1.3 billion, and there was a lot of other funds in the $1 billion or just under $1 billion. So that's how we got to that $26 billion figure. Basically, though, if we take a look at the bottom, remember I told you there's a little rotation out of the stay-at-home stocks, technology stocks have been in favor. We saw that the Invesco QQQ Trust 1 lost about $1.4 billion, and consumer staples select sector SPDR ETF lose about $901 million. So really, again, the story, I think, though, is the change in pace also for fixed income as well. Let's go ahead and take a look at our fixed income funds to see what happened in that group. Basically, when we take a look at the fixed income funds, we see that taxable bond funds for the fifth week and sixth saw inflows, this time to the tune of about $5.4 billion. But it's the second consecutive week they've seen plus side returns. Remember I told you that the long end of the curve on the Treasury side went up. And so I think a lot of people have been moving to first of all, a little bit lower quality and shorter duration funds in order to compensate for the Treasury, getting steeper on that side of the curve. A second consecutive week, though, that they've seen positive returns, 0.92% this week. If we take a look, though, corporate high yield funds took in the largest amount of money. Remember I told you, people are kind of going for yield, but they're also kind of tiptoeing away from that Treasury or risk-off play and kind of going toward the risky asset play. So $3.5 billion there. Corporate investment grade debt funds took in about $1.1 billion. And again, at the bottom of the barrel, as we would expect, government treasuries handed back about $4 billion this week. So again, a flight away from safety. Now, it doesn't mean that they got rid of fixed income. They got rid of the safety. Let's see how that panned out, though, if we take a look at the ETF side of the taxable bond fund universe. Basically, what we saw there is they took in about $1.8 billion. First week in three, they've actually seen inflows. So prior 2 weeks prior to that, they actually saw outflows. And the top winner of this group, if we take a look at play-by-play, the iShares iBox Dollar High Yield Corporate Bond Fund ETF took in about $2.4 billion, and the SPDR Bloomberg Barclays High Yield Bond ETF took in about $791 million. If we take a look at the bottom, we see the iShares. Remember, I told you people are getting away from the treasuries. Again, the treasury yield curve is going up on the long end. We saw the iShares 7 to 10 year treasury bond lose the most, about $1.4 billion in net redemptions, and the iShares 20 plus year treasury bond handed back about $1.1 billion. So that brings us now to our muni bond fund side. And the muni bond fund side actually saw some pretty good numbers coming in. If we add the two together, this is where we get to the numbers that I gave you a little bit earlier, that muni's talking about $1.2 billion. But initially, if we take a look at this group, and I will switch the slide to that. If we take a look at this group, we saw municipal bond funds overall taking about $549 million. It's the fifth week in six that they've seen net inflows. It's been a good trend. Second or third consecutive week, we've seen plus side numbers. This week, they added about 0.15% to their return. Again, you got to remember, these are weekly reports. 0.15 positive numbers. It's a good thing. Really, what we saw, though, was the high yield muni debt. Remember that story I was telling you about, getting rid of the safety, going after more high yield, going after yield as a whole. So high yield muni debt took in about $401 million. Short muni debt took in about 206. And we saw at the longer end the insured and also the intermediate grade muni debt funds, or I should say duration muni debt funds, actually saw some net redemptions. But really, if we add in there one of the bigger numbers we've seen in a while from ETF side, municipal ETFs took about $618 million, the third consecutive week that they've added money to their coffers as well. Well, that brings us now to our final section. That's basically our money market funds. And as I told you at the top of the segment, our money market funds witnessed net redemptions. And we saw for the 16th consecutive week, they lost money this week to the tune of $4.4 billion. And how it broke out is taxable money market funds handed back about $3.9 billion. But really, here's where we see a little bit of change. Institutional investors, they actually went through net redemptions, $5.8 billion they took out of the coffers, probably put it back to work in munis and other areas as well. But the retail investor basically actually added money back to the money market funds, $1.9 billion. So this uncertainty that's still around certainly wasn't captured in the flows for this week. That's pretty common on the mutual fund side. ETF is more immediate to respond. Institutional investors are more immediate to respond, whereas retail investors, it's kind of a slow-moving ship. You and I, when we deal with our 401ks, we really are probably trying to do a buy and hold as best as we can. And if we break it down a little bit further, we see tax-exempt money market funds handed back about $506 million. So that is really the story that we have for you today. There's not a lot of news on the horizon. We're going to look to lockdowns. I live in Colorado, and we just had our governor come on the air and basically move up our severity to a level 1, which they're saying is going to be 25% at restaurants, and they want people to hunker down and stay at home. They're preferring that people don't celebrate Thanksgiving together. So I think investors are going to have to take a quick look to see what's going to happen for the rest of the year. A lot of the schools, particularly here in Colorado as well, they're deciding to do all learning from home. Just about all of them are going to do that here. For after the Thanksgiving holiday, all the way through the Christmas holidays or the end of the year. And at that point, they'll consider reopening again. So I think people will be keeping that eye on that as well. And of course, of great interest and something that could help keep the market on track and rallying is if lawmakers, even though it's lame duck, if lawmakers could get together and actually come up with a decent coronavirus package, aid package, and get some fiscal stimulus rolling again. Well, if I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can join me next week when I'll be talking about the flows and trends for that particular week as well. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.